Welcome to The Explainer. Today we're going to dig into the timeless wisdom of Benjamin Graham. We're going to uncover the investing traps that caught people decades ago, and you'll see how they're still catching unwary investors today with, well, shocking regularity.
And let's just start with this quote from the man himself. It really hits the nail on the head, doesn't it? When the markets get hot and the stories get exciting, all those smart, fundamental rules of investing, they're usually the first things to go right out the window. All right, so here's our roadmap. We're going to explore three huge illusions that trap investors, and we'll look at some real-world examples from back in Graham's day and from our own. Then we'll wrap it all up by arming you with Graham's personal defense against them.
Okay, let's dive right in. The core idea here is really simple. You know, the company names, the technologies, they all change. But the bad habits and the flawed logic that fuel these speculative bubbles, they stay almost exactly the same.
First up, we've got the trap of complexity. This is when Wall Street cooks up some new product that just seems too good to be true. And it's often wrapped in a simple, really appealing story that just happens to hide all the real risks. So Graham uses convertible bonds as the perfect example. On the surface, the pitch is irresistible, right? You get the safety of a bond, which is basically just a loan you make to a company, but you also get the exciting upside of a stock. I mean, what could possibly be better than that?
But, of course, here's the catch. As Graham pointed out, you know that old saying, what Wall Street gives with one hand, it almost always takes away with the other? To get that juicy stock-like upside, you usually have to accept a lower interest payment. Or maybe you have to invest in a bond from let's say, a less than rock-solid company. There is always a trade-off.
Okay, let's move on to our second illusion. This is where we see how these amazing stories about rapid, explosive growth can completely mask a business that's, well, fundamentally just a house of cards waiting for a light breeze. Just take a look at the absolutely insane story of Ling Temco Vat, or LTV. This company was what you'd call a serial acquirer. Just look at that sales growth. It goes from $143 million to nearly $4 billion in less than 10 years. But then, look at the debt. It just balloons to a staggering $1.5 billion, and the company starts bleeding money. This whole empire was built on debt, and it was pretty much doomed from the start.
And Graham asks the billion-dollar question. How on earth was this even possible? Well, it happened because the banks, the very institutions that should have been the sober voice of reason, they got caught up in the hype too. They weren't the brakes, they were the accelerator, fueling the fire with totally reckless lending.
And this slide just illustrates it perfectly, how the growth trap just keeps repeating itself, this time in the form of the hot IPO. Back in 1969, the magic word was franchising. This company, AAA Enterprises, goes public, the stock doubles. Bankrupt in 2 years. Fast forward 30 years, the magic word is internet. A company called eToys goes public, its stock soars, and, well, you guessed it, bankrupt in 2 years. The parallels are just uncanny.
Now this slide is where you can see the sheer disconnect from reality. At its peak, eToys, a startup with only $30 million in sales and losing money, was valued by the market at $7.8 billion. That's over $2 billion more than Toys R Us, a profitable global giant. The story, the hype, it just completely trampled the actual numbers.
So, all of this brings us to our third and final illusion. This really dangerous belief that a huge, respected company is automatically a safe investment. This is that too-big-to-fail mindset, and it causes investors to ignore giant red flags that are hiding in plain sight.
Think about the Penn Central Railroad. In 1968, this was a blue-chip giant, one of America's largest, most respected companies. Its stock was flying high at 86.5, valuing the company at over $2 billion, which was a massive amount of money at the time. It really seemed untouchable. And yet, as Graham pointed out, you didn't need to be a Wall Street genius to see the danger signs. I mean, its earnings could barely cover its interest payments. And think about this. How can a company report huge profits but then pay zero income tax for over a decade? It kind of suggests those reported earnings were just accounting fiction, not actual cash profits the government would want a piece of. But these red flags, ignored by almost everyone, right up until the moment it all collapsed. So you fast forward a few decades, and it's like déjà vu all over again with the telecom giant Lucent. At its peak in 2000, it was one of the most valuable companies in the world, a real darling of the tech boom, held by millions and millions of investors. And just like Penn Central, if you took a quick look past the headlines, you'd see a business built on incredibly shaky ground. I mean, get this. it was loaning money to its own customers just so they could afford to buy its products. Does that sound like a healthy business to you? On top of that, it was using all kinds of accounting tricks to make its earnings look way better than they really were. The stock, of course, completely collapsed, wiping out nearly $190 billion in value.
So, this all brings us to the most important question, right? How do we protect ourselves from these timeless traps? Well, Graham provides a clear, disciplined, and honestly, a surprisingly simple defense.
All right, here it is, your three-step defense. First, if something seems too good to be true, it probably is. Your job is to find the hidden trade-off. Second, when everyone is shouting about a can't-miss opportunity or some revolutionary new trend, that's your cue to be extra skeptical, not to jump in. And third, always do the basic homework. Check the debt, question the earnings, read the footnotes. I know it's not glamorous, but it is what separates real investing from just gambling.
And we're going to end on this really provocative thought from Graham. Wall Street is always going to invent new ways to sell hype and complexity. That's a given. The real question is whether we, as investors, can learn from the mistakes of the past to master our own worst impulses. Because in the end, the ultimate responsibility for sound investing rests right where it belongs, with you.